The Widow's Penalty, How the IRS Steals $73,000 from Grieving Spouses in 2026, and the 4 Assets You Must Move Before the Funeral. Stop scrolling, right now, because what I am about to tell you in the next 30 minutes is going to make you furious. And if you are married and you are over the age of 55, it is going to save your surviving spouse somewhere between $200,000 and $1.3 million of generational wealth that the federal government of the United States of America is right now, today, in 2026, actively planning to confiscate from your kitchen table the moment one of you dies. I want you to picture something real, not a hypothetical, not a textbook example. A real American living room somewhere in suburban Tampa, Florida, on a Tuesday afternoon in March of 2026. Her name is Linda. She is 68 years old. The casseroles from the funeral are still in the freezer. Her husband, Robert, the man she married at 22 in a small church outside Akron, Ohio, the man who worked 38 years as a regional plant manager for a mid-sized industrial parts company, the man who wore the same gold wedding band even after his fingers swelled up from the blood pressure medication. That man died 9 weeks ago. Heart attack in the garage on a Saturday morning while he was changing the oil on the Buick. Linda is now sitting at the kitchen table. She has her reading glasses on, she has a stack of mail, she has a yellow legal pad, and she has a letter from her CPA that she has now read 4 times because she does not understand it, cannot understand it, refuses to understand it. Because what the CPA is telling her, in polite, professional accountant language, is that the federal government of the United States of America is about to rip approximately $73,000 out of her retirement nest egg this year. A nest egg that, by the way, did not get any larger when Robert died, because Robert and Linda did everything right. They paid off the house, they funded the 401k, they never carried credit card debt, they drove their cars until the tires fell off. They were the model American middle-class retirement couple. And now the IRS is reaching across the kitchen table and taking $73,000 out of her hand in a single calendar year. Last year, that tax bill would have been about $18,000. Same income, same accounts, same RMDs coming out of the same traditional IRA. Robert is dead, so the income actually went down, not up. Linda lost one of the 2 Social Security checks, the smaller one. Her gross income dropped by roughly $28,000 a year. She is poor, she is grieving, she is alone, and her tax bill just quadrupled. That, my friends, is the widow's penalty. And if you are watching this video and you are married and one of you has a traditional IRA or a 401k with any meaningful balance in it, you need to understand something right now. The IRS is not your friend. The IRS is not neutral. The IRS has built a mathematical guillotine into the tax code that drops the moment the funeral home pulls the hearse away from your driveway. And nobody, not your broker, not your branch banker, not your generic financial planner with the framed CFP certificate on the wall, nobody is telling you about this trap until it is too late to do anything about it. I am going to tell you about it right now, because I am sick of watching surviving spouses lose 6 figures of their late partner's life work to a tax code that was designed mathematically and intentionally to crush the single filer. Smash that like button right now. I am not asking, I am telling, because the algorithm in 2026 has a documented suppression problem on senior financial truth content. Every like pushes this video into the feed of one more couple who still has time to fix this. Subscribe. Flip the bell. Join the archive before the system flips the kill switch on senior financial education entirely. # the Linda math, word by word. In 2025, Robert and Linda filed married filing jointly. Their combined income looked like this. Robert had a monthly Social Security check of $3,100. Linda had a monthly Social Security check of $1,900. Combined, that is $60,000 of Social Security. Robert had a small defined benefit pension from the company, paying him $18,000 a year. They had a traditional IRA with a balance of $740,000, mostly Robert's old 401k rollover. His RMD that year was about $28,000. They had a taxable brokerage account at a major discount broker worth $220,000, mostly index funds, throwing off about $6,000 a year in qualified dividends. And they had 3 CDs at the local credit union totaling $110,000, paying about 4%, generating $4,400 in interest. Add it all up. $60,000 in Social Security, $18,000 in pension, $28,000 in RMD, $6,000 in dividends, $4,400 in CD interest. That is $116,400 of gross income as a married couple in 2025. Now, look at the dirty trick the IRS plays here. As a married filing jointly couple, Robert and Linda got the standard deduction of around $30,000. They got the additional age 65 plus deduction, another roughly $3,000. They got the senior bonus deduction, created by the One Big Beautiful Bill, $6,000. Their taxable income dropped to roughly $77,000. And here is the beautiful part of being married, the part the IRS hates, and the part you are about to lose. The 12% bracket for a married filing jointly couple stretches all the way up to roughly $97,000 of taxable income. So Robert and Linda paid 10% on the first chunk and 12% on the rest. Their total federal tax bill was somewhere around $8,400 on $116,000 of gross income. That is an effective rate of about 7%. Here is the part they hide. Robert dies in January of 2026. Linda is now a single filer for the entire 2026 tax year because the IRS uses your filing status as of December 31st. There is a tiny grace period called qualifying surviving spouse, which extends MFJ rates for 2 years, but only if you have a dependent child living with you. Linda's kids are 41 and 38. They do not live with her. They have their own mortgages. Linda gets 0 grace period. 0. Her 2026 income looks like this. She loses Robert's Social Security check, so household Social Security drops from $60,000 to $37,200. Robert's company pension had a 50% survivor benefit, so the $18,000 becomes $9,000. The traditional IRA still has roughly the same balance, around $720,000 by year end, and her RMD as surviving spouse is still in the high 20s, let's say $27,500. The brokerage still throws off $6,000 in dividends. The CDs still pay $4,400. Total, $84,100. Linda's gross income dropped by $32,000. She lost a third of the household income. She is poorer than she was when Robert was alive. Now watch what happens. As a single filer in 2026, Linda's standard deduction is cut in half, roughly $15,750. She still gets the age 65 plus add-on, around $2,000. She still gets the senior bonus deduction of $6,000. Her taxable income is now around $60,350. The 12% bracket for a single filer in 2026 ends at roughly $48,475. Linda's taxable income is $60,350. She has crossed the 22% line. But here is where the second blade drops. Her provisional income is now high enough that 85% of her Social Security becomes taxable. And the way the IRS calculates that for a single filer is much more aggressive than for a married couple. The provisional income threshold for a single filer is $25,000. For a married couple, it is $32,000. The IRS shrunk the protection. Suddenly, Linda's Social Security, which used to be partially shielded, is now fully exposed. But that is just the tax bill. We have not even talked about IRMA yet, the income-related monthly adjustment amount, the Medicare premium surcharge. While Robert was alive, joint income kept them under the IRMA threshold for a married couple. Easy. They paid the standard Part B premium. After Robert dies, Linda is measured against the single IRMA threshold. Her MAGI lands her in the first IRMA bracket. Her Medicare Part B premium goes from the standard rate of about $185 a month to roughly $260 a month. Her Part D drug plan gets hit with a $13 surcharge. That is a roughly $900 a year hit, recurring for the rest of her life because she committed the crime of being widowed. Layer the federal tax, layer the new Social Security inclusion, layer the IRMA surcharge, layer the loss of Robert's income. The woman who was sitting at 60% of the household tax bill last year is now paying roughly 4 times the tax she was paying as a couple on less money. That is not a glitch. That is not bad luck. That is the federal tax code working exactly the way it was written. Hashtag the 3 traps stacked on top of each other. Asterisk. Trap number 1, the bracket collapse. The 2026 single filer bracket structure, even after the one big beautiful bill made the lower TCJA style brackets permanent, is roughly half the width of the married filing jointly brackets at almost every level. The 22% bracket for a married couple goes from $96,950 up to $206,700. That is over $110,000 of bracket width. The single filer 22% bracket goes from $48,475 to $103,350, roughly $54,000 of width. Mathematically, half. This is true at the 24% line, true at the 32% line. The whole architecture is built for couples. The second one of them dies, the survivor falls through a trap door. Trap number 2, the RMD crossfire. This catches people who think, well, I will just live off less. The IRS cannot tax me on money I do not spend. Wrong. The required minimum distribution does not care what you spend. The RMD does not care that you are grieving. The RMD pulls money out of your traditional IRA at a percentage dictated by the Uniform Lifetime Table. That money becomes taxable income whether you spend it or stuff it under the mattress. At age 73, your divisor is roughly 26.5. By age 80, you are pulling close to 5% of the entire balance every year. By 85, almost 7%. The IRS forces the income out, and that forced income in a single filer bracket gets taxed at rates that would have been impossible for a married couple. Trap number 3, the IRMA spike. Asterisk. IRMA has a 2-year look back. Your 2026 income determines your 2028 Medicare premiums. So if you do something this year that spikes your income, like finally getting around to doing a Roth conversion in the year after your spouse died because your CPA finally woke up, you just bought yourself a 2-year IRMA penalty that will not show up on your bank statement until 24 months later. The system is designed with delay mechanisms, specifically so you cannot connect cause to effect. By the time the higher Medicare premium hits, you have forgotten what you did to trigger it. That is engineering. Who designed this and why? The Joint Committee on Taxation has known about the widow's penalty since the 1980s. White papers exist. Think tank reports exist. Brookings has written about it. The American Enterprise Institute has written about it. AARP has written about it, tepidly. The information has been sitting in plain sight for 40 years. Every Congress that has had the chance to fix it has chosen deliberately not to. Why? Because the widow's penalty is one of the largest sources of stealth revenue in the entire federal tax structure. There are roughly 800,000 new widows and widowers in the United States every year. The average financial profile of a 65-plus widow includes a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, generates billions of dollars annually in incremental federal revenue. The IRS calls this revenue. You and I call it confiscation from the grieving. Hashtag the 4 assets you must move before the funeral. Asterisk, asset number 1, the traditional IRA, 401k, or SEP IRA. Asterisk. This is the single largest source of widow's penalty damage in the typical American retirement portfolio. Every dollar in a traditional account is a dollar of future ordinary income. The IRS owns a percentage of that account they haven't collected yet. When the first spouse dies, the surviving spouse inherits the traditional IRA, and every RMD comes out at the single filer rate. The fix? Aggressive, multi-year planned Roth conversions while both spouses are still alive and filing married jointly. While you are married, you can fill the 22% bracket all the way up to $206,700 of taxable income. You can convert $100,000 from traditional to Roth in a single tax year. Pay the tax now at 22%, and that money becomes permanently tax-free. No RMDs ever. No tax on growth, no tax on withdrawal. When one spouse dies, the surviving spouse inherits a Roth IRA, which does not generate any taxable income whatsoever. Run the math. $800,000 in a traditional IRA at age 68. Do nothing, the surviving spouse will pull $28,000 to $45,000 a year out of that account for the rest of her life, all taxed at single filer rates, plus IRMAA, plus Social Security inclusion penalty. Lifetime tax cost, $180,000 to $240,000. Convert that account to Roth over 6 years at the 22% and 24% brackets while both spouses are alive. Total tax paid is roughly $180,000. Same money, but the Roth then grows tax-free. The surviving spouse pulls money out tax-free, and there is no ARMA spike. You convert a recurring tax liability into a one-time tax payment in the wider married brackets. That is the move. Asset number 2, the taxable brokerage account. This one is counterintuitive, and most CPAs get this exactly wrong. The secret weapon nobody talks about is Internal Revenue Code Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis resets to fair market value on the date of death. All the embedded capital gain disappears, vaporized. The IRS forgives it. If Robert bought $100,000 of an index fund in 2005 and it is now worth $240,000 when he dies in 2026, Linda inherits the fund with a fresh cost basis of $240,000. She can sell it the next day. Zero capital gains tax. The $140,000 of embedded gain is forgiven. But this only works if the asset is owned correctly at time of death. If the brokerage account is in joint tenancy with rights of survivorship in a non-community property state, only 50% of the account gets the step-up. The other 50% retains the original basis. In a community property state like California, Texas, Arizona, or Washington, you get a 100% step-up on jointly held community property. Florida, Ohio, New York, Georgia do not. Title your taxable brokerage account before death to maximize the step-up. In non-community property states, consider a joint revocable trust with specific community property language, or in some states, a TBE designation. Asset number 3, the unprotected pension. Asterisk. Most pensions by default are paid as a single life annuity, unless the retiring spouse affirmatively elects a joint and survivor option. Single life pays a higher monthly check while the retiree is alive, but pays 0 after death. Joint and survivor pays a smaller monthly check, but continues at 50, 75, or 100% to the surviving spouse for the rest of her life. The IRS requires the non-retiring spouse to sign a notarized waiver to elect single life on a qualified plan. Most people sign without understanding what they are doing. The fix? Pre-retirement, elect the highest survivor percentage you can afford. If you are already retired and locked into single life, you cannot reverse it. But you can buy a permanent life insurance policy on the pensioner's life sized to replace the lost pension stream. This is called Pension Max. The pensioner takes the higher single life payment, uses some of the differential to fund a guaranteed universal life policy, and when the pensioner dies, the surviving spouse gets a tax-free death benefit under Internal Revenue Code Section 101A. The replacement income is therefore tax-free. No bracket collapse exposure. No IRMA spike. No RMD. Asset number 4, the high-yield bank CD and the taxable bond portfolio. Most retirement age couples have $50,000 to $300,000 in CDs, money market funds, or treasury bonds, generating fully taxable interest income every year. While both spouses are alive, the interest is buried inside the wide married brackets. The day one spouse dies, the same interest stream gets pushed into the narrower single brackets and may push the survivor across an IRMA tier. 3 fixes. First, replace high-yield CDs with high-quality municipal bonds from your home state. Interest from in-state municipal bonds is exempt from federal income tax under Section 103 and exempt from your state income tax. Second, shift cash into a multi-year guaranteed annuity, a MIGA, which compounds tax deferred. Third, fund a properly structured cash value life insurance policy. Growth is tax deferred. Withdrawals up to basis are tax free. Death benefit pays out income tax free. State examples: Florida resident, no state income tax. The muni bond strategy is less powerful. Use the MYGA or cash value insurance. Ohio resident, moderate state income tax. The muni bond strategy is decent, especially Ohio-issued munis for double tax exemption. California resident, high state income tax. California-issued munis can effectively yield the equivalent of a 6 or 7% taxable bond for a high-bracket retiree. Hashtag the result if you execute all four. The traditional IRA was converted to Roth, so the survivor inherits a tax-free account. The taxable brokerage was titled correctly, so the survivor gets a full step-up in basis and pays zero capital gains tax. The pension was either elected as joint and survivor or replaced with a life insurance death benefit. The CDs were converted to munis or insurance products. The widow's penalty is mathematically defanged. Linda, instead of paying $73,000 a year in taxes plus IMRMA, pays around $8,000. Same gross income, different account architecture. $65,000 a year recovered. Multiplied across a 20-year survival, that is $1.3 million of generational wealth preserved. Hashtag the final warning. The window to do this work is narrower than you think. Roth conversions take 5 to 7 years of phased conversions to avoid spiking your own bracket and triggering current year IMRMA. Pension elections are typically locked at the moment you start drawing. Life insurance underwriting requires both spouses to be relatively healthy. Trust restructuring requires both spouses to have legal capacity to sign documents. If one of you is already in declining health, half of these tools are off the table. If you wait until the diagnosis comes, you have already lost. The IRS is counting on you to wait. The IRS is counting on you to assume your generic 401k and your standard joint brokerage account and your default single life pension will somehow protect your spouse. They will not. The default settings of the American retirement system are calibrated for maximum government revenue, not for surviving spouse protection. If you are married, today is the day. Tonight is the night. Sit down with your spouse after dinner. Open a notebook. Write down the 4 asset categories: traditional IRA, taxable brokerage, pension election, CDs, and bonds. Next to each one, write what you currently own and how it is titled. That is step 1. Step 2 is finding a fee-only fiduciary advisor or an estate planning attorney who actually understands the widow's penalty, not a salesman who wants to sell you a product. Bring the notebook, run the math, build the plan. Like the video, subscribe, flip the bell, comment your state, your IRA balance, your pension survivor election. Share this with one married couple you love. 1. Today, not tomorrow. The IRS is patient. The IRS has built the trap and is sitting back watching the calendar, knowing that 800,000 new widows will fall into it this year alone. You do not have to be one of them. Your spouse does not have to be one of them. The tools exist. The tax code, ironically, contains the escape hatches inside the same chapters that contain the trap. You just have to read them before the funeral. Stay sharp. Stay angry. And for the love of everything, move those 4 assets before the IRS gets the chance to.